What if you could outperform even your best model by never choosing just one? In today's episode, we reveal a cutting-edge quant strategy that dynamically learns which models to trust and when. This technique doesn't just boost returns, it slashes risk by over 60%. No black boxes, no unrealistic assumptions, just smart math, live tested over 3 decades of real data. Ready to learn how top quants are building self-adaptive portfolios that beat the market without chasing trends? Let's dive in.
Welcome to the Deep Dive. Today, we're dissecting a piece of research that offers, well, a seriously smart way to think about navigating financial markets, especially if you're using quantitative signals.
That's right, we're digging into a paper called Expert Aggregation for Financial Forecasting. It's all about how to effectively combine predictions from different machine learning models. Think of them as different expert opinions.
Right, trying to build a more robust portfolio, like building a smarter consensus among algorithms dynamically.
Exactly, a dynamic, intelligent consensus.
So this is really your shortcut to understanding some pretty cutting-edge quant strategies, the kind of stuff that could genuinely change how you approach building models or even just managing investments.
Our mission today is to unpack this core idea, online expert aggregation, and specifically, why applying it to portfolio strategies seems to be so powerful.
Okay, let's jump straight in. What's the actual problem this paper is trying to solve? We all know machine learning is huge in finance now, promising better forecasts.
Right. But the big challenge, as anyone who's tried this knows, is picking the single best model. It's really tough.
Why is that? Because performance isn't stable.
Precisely. Market conditions shift, What works great today might completely fall apart tomorrow. That's the constant battle.
Financial markets are, well, notoriously non-stationary. The rules kind of change as you play.
Exactly. The underlying stats of the data change. So a model trained on history can become less useful really quickly. Maybe regulations change, or there's some big global event.
And simple approaches, like just averaging a few models together, they don't really cut it.
They help, sometimes, but they aren't adaptive enough. They don't react intelligently when one model starts failing or, another one suddenly gets really good. You need something that learns on the fly.
Okay, so the market's moving target, static models, simple averages, they struggle long term. This brings us to the paper's big idea, online aggregation of experts.
Yes, and the core concept is actually quite elegant. Instead of betting everything on one model or even a fixed mix, you keep a whole set of expert models or strategies running.
And you adjust how much you listen to each one. Dynamically.
That's the key. You dynamically adjust the weight, the influence of each expert over time.
What's really compelling about this for finance?
Well, a big plus is that it makes basically no assumptions about how the individual experts work, or even about the data's distribution. It's designed for unpredictable environments like markets.
How does it make the adjustment?
At each step, say each month, it creates a new combined prediction or strategy. It does this by weighting each expert based on how well it performed recently.
So it's like a constant performance review. The ones doing well now get more say.
Exactly. It has this built-in way to stay relevant.
And there's some solid theory behind this too, right? It's not just a neat trick.
Oh, definitely. The theory guarantees that over time, the performance of this combined strategy gets remarkably close to the single best expert you could have picked if you'd known the future.
The Oracle strategy, they sometimes call it.
That's the one. It's an unachievable benchmark, obviously, but the fact that the aggregation competes effectively with it, that shows how robust the method is.
You don't have to guess the best model up front. No. The aggregation figures it out dynamically. That's powerful.
Competing with an Oracle. Yeah, that gives you some confidence.
The specific technique they use is Bernstein Online Aggregation, or BOA. Can you walk us through how BOA actually calculates those weights? How does it decide who gets more influence?
Sure. So BOA works iteratively.
Yeah.
At each time, so let's say monthly rebalancing it, looks back at how each expert strategy performed recently.
Okay.
Then it adjusts the weight for the next month. The core idea is to minimize a kind of mathematical loss function, basically penalizing experts for being wrong.
Right. But BOA is a bit different.
Yeah, what's interesting about BOA is it's a second order. It doesn't just look at the size of the error, it considers the variance too, the uncertainty, meaning it penalizes big errors more heavily than small ones. This helps stabilize things. It stops the system from, freaking out over one bad month from a generally good expert.
Got it. So it smooths things out a bit, less reactive to noise.
Precisely. And another neat thing about BOA, the learning rate, which is basically how fast the weights adapt.
Yeah.
It's determined automatically by the algorithm. You don't have to sit there manually tuning how quickly it should learn. BOA figures it out as it goes.
Okay, that's helpful. Less knobs to tweak.
Now, where this paper gets really practical is how they apply this. They aren't just aggregating raw stock return forecasts.
No. What are they aggregating?
They're aggregating entire portfolio strategies built from those forecasts.
Ah, okay. That feels much closer to what a real quant manager would do. Aggregating the actions, not just the predictions.
Exactly. So what they did was they first built 13 different long-short equity strategies.
13 experts,
Yeah.
using different types of models.
Yeah, a whole range. Simple linear models, tree-based ones like random forests, gradient boosting, and several kinds of neural networks. A real mix.
And what data did these models use?
They fed them a lot of data. 94 different company characteristics, things like value ratios, profitability metrics, leverage. Standard stuff, but a comprehensive set. They use this to predict stock returns 1 month ahead.
For a big universe of stocks.
Yes, a huge set of U.S. stocks.
And these were market-neutral, long-short portfolios.
That's right. Zero net investment. For each of the 13 expert strategies, they'd buy the top 10% of stocks based on that expert's forecast and short the bottom 10%.
Okay, standard quant approach. Isolates the signal.
And here's a clever detail.
Oh.
They applied the BOA aggregation separately to the long side and the short side of all 13 strategies.
Oh, interesting. Why do that?
It allows the aggregation to potentially pick different experts for longs versus shorts. Maybe one model is great at finding winners, but another is better at identifying losers to short. It optimizes each leg independently.
Makes sense. You might need different skills for each side. Okay, so the theory sounds good. The setup seems smart. How did it actually do? Let's get to the results. How did PTF-BOA, the aggregated portfolio, perform?
Well, they tested it over a long period, nearly 30 years out of sample, from 1987 to 2016. The results were pretty compelling.
Give us the numbers. What was the Sharpe ratio?
PTF-BOA achieved an annualized Sharpe ratio of 2.73.
How does that compare?
It was better than the best single expert strategy on its own that was a neural network, NN2, which got 2.67, and it was also better than just mixing them all equally, the uniform portfolio, PTF-UNI, which is 2.54.
Okay, so better risk-adjusted returns, a decent improvement over the best individual model, but
Yeah,
you mentioned risk reduction earlier. Was that the bigger story?
absolutely. This is, I think, the critical takeaway. PTF-BOA significantly cut down the downside risk.
Oh, significantly.
Okay, get this. The worst single month for the best expert, NN2, was a loss of 13%. 13%.
Ouch, that's a bad month.
Right. For the aggregated portfolio, PTF-BOA, the maximum monthly loss was slashed to just 5%.
Wow, from 13% down to 5%? That's huge.
It's more than a 60% reduction in that worst-case scenario they reported.
Yeah.
And similarly, the maximum drawdown, the biggest peak-to-valley drop, was also much lower, 9% for PTF-BOA versus 14% for NN2.
So the real magic wasn't necessarily blowing the doors off on returns, but fundamentally changing the risk profile, making it much smoother, much less scary in bad times.
Exactly. Much more robust.
And did it achieve this by just trading less? Was turnover lower?
No, actually, the portfolio turnover was pretty similar, maybe even slightly lower for PTF-BOA, around 79% annually for the evaluated version.
So it wasn't just hiding by being inactive. The risk reduction came from the combination.
Yes, from the intelligent, dynamic combination of these different strategies.
Why do the authors think this happens? Why does mixing them dynamically cut risk so much?
They put it down to leveraging the complementarity of the different experts.
Complementarity, meaning they're good at different things.
Exactly. Different models might pick up different signals, or maybe they perform well in different market regimes. The aggregation isn't just picking the best one overall. It's building a team portfolio that benefits from the diverse strengths of multiple players at the same time.
Like a well-balanced supports team?
Sort of. Their analysis showed, for instance, that the neural network, NN2, was a big driver of average returns. But a simpler linear model, OLS plus H,
OLS plus H, ordinary least squares, with Huber loss.
that's the one. It proved incredibly valuable for managing risk. The aggregation learned to lean on NN2 for return potential and OLS plus H for stability, dynamically adjusting that balance.
Okay, let's look under the hood then. Who are the stars within this PTF-BOA mix? You mentioned NN2 and OLS plus H. Did they dominate?
Over the long haul, yes, those two really stood out. While the weight shifted constantly, on average, NN2 and OLS plus H captured about 77% of the total weight in the mixture.
That OLS plus H one is kind of surprising, isn't it? A relatively simple linear model holding its own against fancy neural networks.
It is fascinating, especially since, in raw prediction accuracy tests, the neural nets often look better. But OLS plus H, probably because of that Huber loss making it robust to outliers, turned out to be a very stable, reliable contributor, crucial for taming volatility.
So NN2 brought the horsepower for returns, OLS plus H brought the stability and risk control. The aggregation figured out how to blend them.
That seems to be the story. It wasn't just about maximizing return. It was about building a reliable portfolio.
How did this mix behave during really tough times, like the 2008 crisis? Did the weights swing wildly then?
Well, the crisis obviously hammered performance for everyone, including the aggregate portfolio. But interestingly, the paper notes had only a fairly small, temporary effect on the relative weights of the experts within the aggregation.
Really? The leaders stayed leaders even then?
Largely, yes.
Yes.
NN2 and OLS plus H kept most of their importance. It suggests the aggregation identified experts that were fundamentally useful, not just in calm markets, but whose relative strengths held up even during extreme stress.
Okay, so even though two experts dominated the average weights, the dynamic nature was key. Was PTF-BOA consistently the best performer, or did it bounce around?
Looking at performance ranks month by month, PTF-BOA hit the #1 spot about 20% of the time, which might not sound overwhelming, but
it was more consistent than any single expert.
exactly. The individual experts like NN2 or OLS plus H, their ranks jumped around a lot more. Sometimes they were #1, sometimes they were way down the list.
Yeah.
PTF-BOA was much more consistently near the top. That really highlights the robustness benefit you get from aggregation.
You avoid the agony of your chosen best model suddenly having a terrible run.
Right. The aggregation smooths that out.
Did they try to push performance even further? Any tweaks to the aggregation?
They did explore a couple of things. First, they tried pre-training the weights, basically using data from before the main test period to give the aggregation a running start.
Did that help?
It gave a small boost. Sharpe Ratio went from 2.73 up to 2.75. Marginal, but positive.
And the other idea?
Expert specialization. They took the two champions, NN2 and OLS plus H, and created slight variations of them, using bagging like creating slightly different versions of your best players. They added these variations into the original pool of 13 experts.
Ah, so reinforcing the strengths. Did that work?
It did. Adding those specialized experts nudged the final aggregated Sharpe ratio up again to 2.76.
2.76. How good is that?
Interestingly, that matched the performance of the theoretical oracle, that hindsight perfect benchmark.
Wow. So they essentially reached the theoretical best possible fixed mix performance, but did it dynamically.
Pretty much. And crucially, they did it while keeping those fantastic low-risk numbers, like the 5% max monthly loss. They squeezed out a bit more return without adding back the risk.
Okay, so wrapping this up, the big message seems to be that applying this online aggregation idea directly to portfolio strategies, it really works.
Yes, it looks like a very effective and practical approach, especially for markets that, refuse to sit still.
And it's practical, not just theoretical.
Right. It's computationally pretty efficient. And a huge plus is it doesn't force you into making rigid assumptions about your models or how the market data behaves. That's massive in the real world.
So by constantly monitoring and dynamically weighting these different strategies based on what's working now, you get
better overall performance,
Yeah.
higher risk-adjusted returns, and critically, I think, much, much lower tail risk, less chance of those really bad drawdowns compared to relying on just one model or a simple static mix. It harnesses that complementarity.
This deep dive really drives home the power of combining different quantitative views intelligently, adaptively.
Yeah, it kind of shifts the goal.
Yeah.
Instead of searching forever for the single perfect model, which probably doesn't exist,
Right.
the focus becomes building a resilient system that learns and adapts. It leverages the strengths of different approaches, even as those strengths ebb and flow over time.
So here's a final thought for everyone listening, especially if you're building systems. We saw huge benefits here aggregating different equity strategies, particularly in slashing risk. How could you push this principle further?
Could you aggregate strategies across completely different asset classes, maybe? Or what about combining quant signals with, say, discretionary macro views?
Or even aggregating different styles, momentum versus value, maybe within one adaptive framework. What other kinds of experts could you throw into this dynamic mix?
Exactly. How could you use this dynamic weighting to build truly robust, all-weather strategies? Something to definitely think about.
We hope you found this deep dive insightful.
So, what did we learn? Dynamic expert aggregation can outperform your best model and slash your biggest losses. This could redefine how you build quant systems going forward. If this sparked new ideas or gave you clarity, do us a favor. Subscribe to never miss a breakthrough. Like this episode if it made you think. Share it with a fellow investor or quant. It could change their game too. See you in the next deep dive. Liked how that paper got decoded? We've spent 20+ years turning machine learning and AI into real-world tools, not just slide decks. Whether you want to implement a model, validate research, or build something from scratch, we can help. Explore our showcases to see it in action. Visit our site or contact us directly. Let's turn complex ideas into working intelligence together.